Good day, good morning, and good afternoon, wherever you are. This presentation is being made in Florida. The presentation is at the location of Palm Beach State College and is being made by Professor Dr. U.S.A. The presentation is all about managerial technology economic analysis in the United States. And then the presentation goes as, is it true that U.S. technology economy depends on the spending patterns of the consumer? After thorough research, it is quite agreeable with the fact that spending by consumer sector is the driving force of the United States technology economy. Research found that without the consumer spending, the economy will be in jeopardy. Consumer spending will result in economic growth, which means an increase in real GDP. And the causes of economic growth are increase in aggregate demand and increase in aggregate supply. What we mean by economic growth is the increased national output and national income. For example, lowering the interest rate will reduce cost of borrowing and so encourages spending and investment, which may lead to higher demand and supply of goods and services. For instance, the annual economic growth in the United States is about 12 to 13 trillion per year, and the highest part is created by you and all other consumers in the country. Warden, according to Warden, an economist, he explained that consumer spending accounts for 3/4 of the 13 trillion American economy created per year. It could be a chaotic situation when people are not spending due to higher prices, low income, unemployment, high interest rate, and other social economic factors. The economy depends on demand of goods and services and the supply of those goods or services by the manufacturer and the retailer. Now, when people spend more, the economy tends to be robust because producers can dispose or sell off goods, and more services can also be rendered, thereby increasing revenue and profit. High demand of goods and services will certainly realize profit with lower minimum costs attributed to production. Also, high demand of goods and services may call for increase in supply, therefore creating a surge in employment rate. Today, unlike 8 years ago, when we had a recession, the economy was rampant and the income was low and nobody could afford anything. The so-called Obama economic stimuli introduced by President Barack Obama and the world dignitaries have contributed greatly to the revitalization of the economy. Even though economic stimulus has pumped money into the circulation, we still may face another problem, which may be decrease in the value of our currency, and thus driving prices up. Nevertheless, economic stimuli have so far helped as incentive to corporations and consumers. The stimuli have allowed consumers to increase demand and make corporations to increase production and create jobs. It is true that it is not only the consumer that make the economy prosper. Businesses, government also play a role in the economy of a country and corporation. The United States technology economy is driven perhaps like the example of the consumer-based society and capital-driven citizenry, according to article in the Investor Guide of 2013. The role of the government is very important role because businesses and consumer alike depends on the decision making of the government official concerning the law and the budget spending of the government. The activities of the consumer, government, and businesses are what drive the economy, what drive the economy to prosper. Government must also focus on stability. While consumer products make more decisions that mold the government, management activity are powerful effects in the U.S. economy. You know that when danger of recession approaches in 2008, government sought to strengthen the economy by heavily spending itself and cutting taxes, so the consumer will spend more. And since spending and taxes are controlled by the President and the Congress, the elected officials play a role in directing the economy. The economic factors, according to so many textbooks and managerial, according to research and so many textbooks read, of managerial economy. The economic factors of a country, corporation, organization must be taken into consideration when managers make decisions concerning the well-being or success of a corporation and organization. This economic factor may have to include cost, available resources, revenue, employment, and expenditures. To be considered also are demand and supply of goods and services. Explained further in the research is that there is a relationship between cost, revenue, and this also influence decision making by managers. The marginal incremental relations take place in the process of determining both cost and revenue. Manager must always maximize profit or revenue while minimizing cost overhead, so to say. Marginal analysis gauges the effect of unitary changes, that is, the number of changes in unit, while incremental analysis focuses on changes among available resources. It is the manager's job to make decisions according to the economic condition and available resources of the company environment. Decision-making paradigm should be part of managerial economics profile. Manager must apply economic theory and method to all decision-making process. It should be recognized that cost, revenue, and profit depend on the application of economic theory in the workplace. Managers should be well-rounded and have skillful, knowledgeable, and have experience in all aspects of economic management to succeed in leading their corporation to profitability and success. Now, deadweight losses. Deadweight losses in economy are known as excess burden or allocative inefficiency. That is, they are losses of economics. Deadweight losses are losses of economic efficiency that can occur when equilibrium for goods or services is not Pareto optimal. By Pareto optimal would mean resource allocation where it is impossible to make any one individual better off without making at least one individual worse off. Nevertheless, deadweight loss is the inefficiency created in the market, typically due to demand and supply issue that have negative impact on society. Deadweight loss can include actions that prevent the market from achieving an equilibrium clearing condition. And this includes taxes, subsidy, and binding price clearing where supply equal demand. The most common reason for deadweight loss is government actions, such as taxes or supply control and price control. Deadweight loss can generally be referenced as the loss of surplus to either consumer, producer, or both. Technically, deadweight loss may be defined as the waste resulting from economic inefficiency of any kind, be it through poor design, regulation, or antiquated production techniques. Deadweight losses are also caused by subsidies to corporations. The subsidy shifts either the demand or supply curve to the right, demanding upon whether the buyer or seller receives subsidy. If it is the buyer receiving the subsidy, then demand curve will shift right, leading to the increase in the quantity demanded and equilibrium price. If it is the seller who received the subsidy, then the supply curve shifts to the right and quantity demand will increase, while the equilibrium price decreases. Another thing is who bears the sales tax burden. It is straightforward to determine who pays the tax. However, it is a difficult issue to assess who bears the tax burden. The answer is significant for designing tax policy at the state level, and this is particularly true when assessing the equity of potential changes in sales tax base. Many changes are explicitly motivated by equal concern, which suggests the need to evaluate incident. Now, deadweight loss. When we have deadweight loss, consumers lose confidence and are unhappy. Production and supplies are also affected because of the effect on cost. Pricing may also be affected. For example, the auto industry suffered deadweight loss because of low confidence due to recalls that occurred over the past 12 years or 12 months. When there is deadweight loss, price will normally increase, thereby causing demand to fall. The major factors that determine who will bear the burden of a tax or incident tax depends on income, taxes, and pricing. Both the producer and consumer are the ones that bear the burdens of a tax or incident tax. Tax authorities usually require the buyer or seller to be legally responsible for payment of the tax. We should know that tax incident is the way in which the burden of a tax is shared among the market participants. Taxes will constitute a greater burden for whichever party that has more inelastic curve. For instance, if supply is inelastic and demand is inelastic, then the burden will be greater on producer. For example, suppose the state government imposes a tax upon milk producer of $1 per gallon, and the original price of milk was $2 per gallon. After the imposition of the tax, supply curve of milk will shift up, and to the left, signifying reduction in supply. Let's say consumer pay $2.60 per gallon. That means seller will receive $1.60 after receiving the tax of $1. Also, this means that 60% of the tax is actually paid by the consumer when 40% is paid by the by the milk producer. It is true that government has policy and measure to encourage new farms to join the perfect market to reduce monopoly in effect. This also increases competition among farms because a new farm is entering the market. That means, when I say farm, I mean new company. A new company is entering the market. That means more products in the market which may give rise to higher price. Economic theory identifies many situations where the government could correct failure and improve economic efficiency. According to Luton, an economist and a perfect and great economist. Potential market failure such as market power and imperfect information do not appear to create large efficiency loss to U.S. economy. However, market failure arising from externality such as air and water pollution, hazardous waste, and traffic congestion will impose significant social costs that government policy could reduce efficiently. Government policy to correct market failure may be characterized by two major flaws. First of all, government policy has created economic inefficiency where significant market failure do not appear to exist, such as with antitrust law and economic regulation that has raised farm costs, and generated economic rent for various interest groups at an expense of consumer welfare. Secondly, in situations where market failures do exist, government policy has either achieved expensive successes by correcting these failures in a way that sacrifices substantial net benefit or in some way has reduced social welfare. Government policy has wasted resources, which is application of command and control policies to correct externality, especially in the health, safety, and environmental policy. For example, more efficient use of super funds could reduce the health risk from hazardous waste for more residents at lower cost. In some situations, government failure arises because government intervention is unnecessary. That is, the market can adequately address their possible failure. Consequently, government intervention may prove to be counterproductive because market failure policy are flawed or poorly implemented, and because policymakers are subject to political forces and enable certain interest groups to benefit at the expense of the public. Now, application of taxation. If the government uses taxation to deal with the situation, various elasticity of supply and demand will affect the delivery loss of tax as follows. If buyers have many alternatives to a good with a new tax, they will tend to respond to a rise in price. Other things will therefore not accept a much higher price. If seller easily can switch to producing other goods, if seller easily can produce or switch to other goods, or if they will respond to even small reduction in payment, then going out of business when they will not accept a much lower price. The incidence of the tax will tend to fall on the side of the market that has at least attractive and therefore lower elasticity. Cigarettes are one example where buyers have relatively few options. We would therefore expect the primary burden of cigarette taxes to fall upon the buyer. To better see how elasticity of supply and demand affect tax, consider 20% tax on a soda. Suppose government decide that the buyer should pay 20% tax on a soda. Does this mean that the buyer will be paying 20% more, or will the seller have to share some of the burden? Since higher prices decrease demand regardless of the reason for higher prices, seller will have to share some of the burden. How much of burden will be determined by the elasticity of supply and demand for that product. Only if either demand or supply was either completely elastic or inelastic, with tax burden fall entirely on either the buyer or the seller. Between these two extremes, tax incidence was continuously for perfectly inelastic supply or perfectly inelastic demand, where seller assumed the entire burden of the tax to the perfectly inelastic supply or perfectly inelastic demand, where buyer bears the entire burden. The tax burden will fall more on the buyer if demand is inelastic and supply is elastic, but will fall more on the seller if demand is elastic and supply is inelastic. Now, to summarize the managerial economy analysis of the country, to summarize so far, labeling: government cannot provide goods or services to the public efficiently as the private sector. This is very controversial because some services can be provided efficiently by the government. This means that it depends on the kind of product or services. For example, the Affordable Health Care Center cannot be managed alone by the government. That is the main reason why private insurance companies are involved. For some goods or services, it is more profitable and efficient to privatize their production. First, let's define privatization. Privatization is the sale of public assets, such as state-owned railroad, water utility, to the private sector. Government privatizes the asset for several reasons. One of the reasons is to shed state enterprises that are operating at a loss and drawing government coffers. Another is the hope that private owners will run the enterprise more efficiently, bringing better service that the state could provide. As it was said previously, it is very controversial when government proposes privatizing essential services like water delivery and electric power provision to the private hand. The worry is that companies may increase the efficiency of the enterprise by ignoring the social objectives in the bargain, such as cost of the merchandise, affordability. The theory of privatization is that private companies are more efficient than government. Therefore, suggests that public officials, politicians, bureaucratic lack the incentive to run the enterprise efficiently. Also, there is no competition or takeover threat as they would in typical business, that the public does not scrutinize performance as shareholder in private company. In government, public managers often balance contradictory objectives. Efficiency may in public sector be sacrificed to increase social benefit, such as employment and so forth. Now, to consider the risks. The risks are controllable risks, which are the risks that are due to factors that are under direct control of the business. Most controllable risks are internal risks that arise from business itself. Controllable risks happen because at times the business is not able to conduct properly. And the information technology must face several problems since the risks are mostly related to business. They are easy to control. There are different types of risks. We have a good example, which is operational risks that are related to day-to-day operations of a business. Controllable risks are risks associated with compliance, which are subject to legislative and bureaucratic rules and regulations, or those associated with best practices for investment purposes. The way to incorporate risks into decision-making process and to get senior management on board, discuss the risks that the organization are facing, how these risks are currently analyzed, and how decisions are made to manage identified risks. Other ways are to perform short review, train analysts, perform simple risk analysis, set up corporate risk register, identify and set up project level register reflecting various scale of project, and create senior management dashboard. Executive summary. As I will conclude in this presentation, if the economy is to reach a higher peak of success, government and the private sector should utilize all resources to the optimum. Services and production should be maximized, and taxes should be minimized. All risks, both controllable risks, operational risk, and financial risk, should also be minimized when taking action. Appropriate action should be taken by both the consumer, government, and the industry to maximize both social and economic factors. Well-rounded, many educational material and observation should be employed and examined in writing and thinking of the situation of the economy, in writing about the situation of the economy. More thorough research should be implemented, and then the finding should be exposed to the government, to the public. I would like to end this presentation with a thanks to you for listening, and then a thanks to the entire audience, and for those people who will introduce other people to read the presentation. As I said before, this presentation is being brought to you by Professor Watson Kijawa at Palm Beach State in Florida. Thank you, and I will see you later. I'll see you soon in person. Okay, thank you so much.